Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have the founder of RaperCapital.com and my friend, Jeremy Raper, back on the show. Jeremy, how's it going?
Hey, Andrew. Thanks for having me back. I'm well. How are you?
Doing good. Well, let me start this pod the way I do every pod, and that's by pitching you, my guest. And look, it's not going to be hard to pitch you because you were the first person on the show and I'm having you back on. So that should speak for itself. But, anyone who's listened to me knows I love and respect your work. Your RaperCapital.com is one of the 2 or 3 people email me, hey, what subscription service should I sign up for? And every time, love the subscription service. There aren't many people who can get me to tape a podcast at 7 p.m. on a weeknight, and you're one of them. So, I just love the work. I love everything you write. I'm glad you came on, and that's my pitch. So that
awesome.
Out the way.
Thanks, man. I appreciate your support. And listen, another happy customer makes me happy. So I'm really glad to have you. And yeah, I do apologize for the time. It's just I recently maybe for everyone else, I can let them know I recently moved to Tokyo. So lining up a Tokyo East Coast call is a little trickier than London East Coast, which is pretty, it's a good 5-hour difference. But thanks for taking time out of your evening to do this. I do appreciate it.
Hey, not a problem. And I'm happy to, because we always talk about so much interesting stuff. For those who, we talked for 20 minutes before this podcast started about a lot of stuff. So anyway, let's do some catching up. Last interview was early August. You were still living in London. Now it's late November. You're in Tokyo, but I think we're in a completely different environment. And most years from August to November, you couldn't say that. But here, we're seeing a huge second wave of COVID. Don't even know if it's a second wave, but a lot of places are about to go back into lockdown or have already locked down again. We've obviously got a dramatically different administration in the United States. How is your views just of the overall environment and where you're seeing opportunity? How have they evolved over the past few months?
Sure. I mean, look, let me caveat what I'm about to say by saying I'm not the best macro prognosticator and or market timer, so to speak. So take that with a grain of salt. What I kind of focus on is kind of like, the peripheral things you notice from talking to other market participants, and not even so much professionals such as yourself, but just like general people. And you kind of gauge how many people are, paying attention to the stock market, what they're trading, things like that. I'm sure lots of your friends have reached out to you recently and started asking about stocks and what they should be looking at or telling you what they're trading. I certainly know a lot of my friends have very long lists of the hot tech stocks du jour, guys who were otherwise pretty conservative and cautious with their money suddenly email me saying they own a bunch of Tesla and they're really happy, and they're crushing my returns, by the way.
They're crushing everyone's returns. Yeah.
I think as someone said it best, I was listening to another podcast and someone said the stupidest person is getting the richest this year. And that's basically how I think about the market. Like most of the time in the stock market, the obvious thing to do is the wrong thing to do, right? First derivative thinking is punished, not rewarded, right? And yet for most of this year and in accelerating fashion since the election, let's say, but definitely recently, doing the first derivative thing has been the only thing to do, and trying to think at a second derivative level has been extremely painful. Like you can pull up things like look at the stock price of Palantir. There was a great analysis, right? Someone on Wall Street Bets on Reddit broke down why Palantir stock was going to the moon, and this is like a $60 billion company, right? And it went up 70% in 3 days or whatever. And I think in a nutshell, it's some combination of a huge amount of retail speculative money has entered the market, right? And it's looking for a home. It's gravitating towards these situations which capture the popular narrative, whether that be around EV, whether that be around tech, whether that be around, stay at home. And it's being massaged and guided by a whole host of people online who have a lot of pelts on their belt at this stage, right? Like the new high priests of the the 4 horsemen of the apocalypse type guys, like the Puru Saxoners of the world and the ARK Invests of the world. They're looking at those performances, and those returns are, huge staggering returns over a very short period of time. And it's hard not to get sucked into doing that. But look, it's always that way right before you hit a massive wall, right? Like this is always, it seems, the easiest to make money right before it becomes extremely difficult to make money and or just to protect your money. So, I mean, look, it's kind of a rambling intro, but I try to do what I've been doing, right? I mean, I try to stay true to my process and try to find things where I can justify the valuation on an absolute level, not just a relative level, where I know I'm paying a reasonable price on a, let's say, an above average, I don't want to say a hugely high quality business because I've been known to dumpster dive now and then, but where I'm paying a very attractive entry price, right? And that's part of my protection, is the price I pay is hopefully low enough relative to what I'm getting, that maybe there is some mistakes along the way and I'll still do okay. Combined with some kind of exogenous factor, some catalyst that's going to get the market to view that asset or that security differently.
Yep.
That hasn't changed. So all this mania and manic behavior is going on around me, and around you as well. And I mean, frankly, to the extent I'm participating by not shorting some of these things, whereas before I would have, and I've been carried out and learned my lesson.
That's actually what I was going to mention, because I know you run, I think our last podcast, you mentioned you run pretty much beta neutral. I think I know you run a much kind of heavier short book than me. One of the hardest things for me to do this year, last year, has been, look, there are some things that I think are obvious frauds or obviously overvalued, like, but it's really difficult to short them. You know, there are some Chinese companies I've looked at that it's completely obvious their financials are fraudulent, right? Like, I don't know many people who don't think the financials are fraudulent, but the stocks are up 5x this year because they're huge gamma plays. And as you mentioned, like, Wall Street Bets is buying calls and they're trading sardines, but they're trading sardines up 5x. And how are you going to short when you could be 100% right? The company basically admits they're a fraud and the stock will go up 5x anyway.
Because so just referring back to our original conversation, or maybe something we've talked about offline, but there's I guess 2 or 3 ways to catalyze a short, right? So either the capital markets realizes that they're running out of rope, right? Let's say they're a massive cash burning enterprise. The capital markets wakes up and says, we're no longer willing to fund this enterprise, right?
Yeah.
And or there is some kind of exogenous enforcement of pure fraud, right? So these are the 2 key levers. Now, if both of those levers don't apply, so for example, in an environment where there is literally, we're swimming in excess dollars or swimming in excess cash. So the capital markets are open for everyone at all times. Well, let's just stick with the US market for now, right? This is more of a US phenomenon than a European or other market phenomenon. I'll explain how that relates to what I'm doing. But if the markets are open at all times and there is no balance sheet pressure, there's no balance sheet kind of gravity being applied, you have those situations. And the most obvious example is one where I, honestly have taken a huge bath this year, and that's NIO. So it's a Chinese EV company where...
That's the one I was thinking of, but I didn't want to rub any salt on the wound here.
I mean, look, you can go through the analysis, and I basically nailed the analysis. Not that it helped me. I mean, they sell a product at negative gross margins. Okay, the gross margin has climbed positive because they've managed to get some semblance of leverage after burning through huge amounts of cash and managing to raise volumes significantly, but they sell a product at 10% gross margin with huge costs below the gross profit line to obviously develop their technology in a hyper competitive space. It's just getting more competitive. They've burned cumulatively $2.5–3 billion in their life. They don't really have a sniff of making real operating earnings ever, and yet the market thinks it's worth $75 billion. So again, the point being, if the market is willing to fund the dream, there's no limit to how big the dream can get before the market decides not to fund the dream. I mean, is it really that different between a NIO and a Netflix? It's kind of a philosophical point, right? But Netflix has never generated positive free cash flow on an annual basis.
Well, I would push back on, because Netflix, you can see, like, they've got huge competitive advantages where, like, anyone who the first thing I do when I turn on and want to watch something with my wife, we flip to Netflix and we see what's out. And, like, you look at something like The Queen's Gambit, right? Or I've mentioned Cobra Kai before. Dud on YouTube, comes over to Netflix. It's the biggest hit in the United States for a month, and they're going to have season 3 coming out. Like, that distribution they have is a competitive advantage, whereas NIO, it's just like, it's a Me Too electric vehicle product.
That's true now, but that's also an ex post facto judgment based on the availability of free capital. In other words, the ability to build competitive advantage is only because the market has been willing to fund these dreams for 8, 9, 10 years, right? Which is itself a function of monetary policy, right? If the market applied a Disney cost of capital to Netflix over the last 5-6 years, they wouldn't have that advantage. And so, so for example, I mean, we don't have to talk too much about Netflix, even though it's very interesting. As more and more of the Netflix economics rules get applied to the Disneys and the like, you have to really reconsider, are those advantages going to remain? Because all these other companies that can afford to acquire customers and who have that native content or can afford to create that content They're just going to copy the playbook. I mean, it's exactly the same reason why Warren Buffett doesn't invest in these kind of high growth companies, because, you know, you would think that that kind of moat, as it is today, which is a valid point, gets competed away. But I guess going back to your real question, I mean, like the one way I'm doing it is on my short book, I essentially have nothing in the United States. So, I mean, if the US is the epicenter of the mania, why would I try and take shots there? Right?
Don't compete with the Robinhooders. Go where Robinhood can't trade.
Basically. So I mean, look, I have the odd position here and there. Let's not kid ourselves. You know, like I actually am short a couple of stocks in the US as it relates to this conversation. But I mean, on a very tight leash and around with very kind of tight kind of stops. Let's say. Go on.
I don't want to ruin what we're about to talk to, but I think one of the ways I've done it too is, hey, I really like this insurance company. You know, I take a 5% position in the insurance company, and then I see 4 insurance companies in the same field that I think are overvalued, or maybe they're fairly valued and the other ones are very undervalued. But I take, you know, 4 25 basis point position shorts across those 4. So you're just kind of hedging some of your beta risk out, but you're not exposed to, hey, you know, I think it's worth 2 times the book value. It trades for 5 times. Tomorrow I wake up and it's at 20 times, and all of a sudden it's blown my entire book up.
That's right. I mean, look, so position size per name goes down, concentration goes down, exposure to the US goes down, frankly, because I mean, like the rules are completely different. If you look at Europe, right? So, you know, we talk about this on the long side a lot. Like we talked about GAN last time as being a long, getting a 2 times sales multiple in the UK and then a 20 times at one point in the US. But
I mean, you hit the ball out of the park with that one too.
Think about on the short side, right? Or at least on the negative side, right? Like the availability of capital to some of these really crappy names. If they were simply listed in the US, they'd be able to sustain these stories. Whereas, like, I don't know, what's a good example? Maybe something like take American Airlines. Okay. So completely busted enterprise, a completely busted capital structure, right? There's literally no way by the way, I'm not short American Airlines, just as an observer. There is almost no way under any kind of normalized scenario they can earn back to repay equity holders with any kind of residual value in any reasonable time frame, given what's happened with COVID, the amount of cash they've burnt, the amount of debt they've had to relever, put back onto the balance sheet, etc. Right? So compare how that stock has performed versus, say, British Airways, right? Which was nowhere near as levered coming in, was actually a much better business in terms of their monopoly routes, the Atlantic, etc. And the equity performance, I think, is a lot worse. And they were forced to do a massively dilutive rights issue near the bottom before the vaccine, even though they weren't carrying, 8, 9 times pro forma leverage or whatever American had. They were maybe 1.5 times levered, including some of the COVID leverage hit, right? But the market just has no tolerance, and they have the equity market culture is completely different. And so, look, that's kind of a high profile example, but there's down the market cap curve in the UK, for example, the market's willingness to tolerate a profit miss, even if it's due to, COVID or whatever, on even modestly levered capital structures is so much less, then therefore the barrier to kind of getting paid on the short side is so much lower. And that's more an attitude related or market participant related. I'm not sure. But so for example, one of the more successful shorts I had this year is a company called Rank Group. I think it's RNK, I think, in London. It's not a large company. They operate physical casinos. They have an online business as well, but like 70-80% of their revenues pre-COVID came from physical casinos and bingo halls in the UK. So it's a nice pair for, say, some of my other gambling exposures, which are more online related. But yeah, I mean, look, it wasn't really levered. I just kind of looked at it and thought, they're going to burn a shitload of cash. COVID's obviously going to hurt them a lot, huge fixed cost deleverage, or, the typical story you've heard, and the market's going to punish them for it. And yeah, sure enough, the stock went from trading at a relatively cheap multiple to just being given away, basically. Something is very hard to kind of to receive in the US, I think. So in a short answer is, one, I'm doing less shorting, right? Because it's cost me. So I'm running slightly longer than I normally do. 2, I do try to look only outside the US with a few exceptions. So basically I'm in Europe, a lot of shorts in Europe and Japan. And then 3 is I also just have to dial back on the long side and lower the position size.
Yeah, no, that's great. No, all of that's super interesting. I think I've put it out there a couple times, but one of the things that most fascinates me about the stock market today is you look at the cruise lines or you look at a Dave and Buster's, and like they're basically trading for the same enterprise value as they did at the start of years. Or AMC Theaters, I think, trades for a significantly higher enterprise value than it did at the start of the years. And you're like, like these guys have burned 9 months of cash. They're going to burn another 9 months of cash. They're raising debt at huge amounts, and the equity market's just like, yeah, whatever. We'll look to 2024 normalized earnings, and this thing's worth more, and it just makes no sense. Yeah, any particular sectors that you're seeing opportunities on the long side? I thought going into October, I thought you had a really interesting tweet where you said, hey, now is not the time to go buy kind of the vaccine recovery plays, which it was the time, it turned out. But you were saying, look, the next 10 months.
I told you I wasn't a good market timer, right? I did say that.
Hey, I think you're a smart guy, and I like to hear your thoughts. But you were saying, look, the next 10 months are going to be still really bad. Like now is actually the time to press work from home, because they're going to be taking more share and more money for the next 10 months. Are you anything interesting there?
Well, okay. So that is true. I did say that, but I think I tried to qualify by that saying you don't go out and YOLO on Zoom calls, right? So obviously valuation is paramount. What I meant by that is there are some kind of secular winners from work from home and or from COVID that are still being priced as if that was a one-time benefit or very temporary benefit, right? There's obviously a whole host of other names where they're being priced as if it's a secular shift that'll never change, like the Zooms of the world, right?
Mm-hmm.
I'm not talking about those. I'm talking like names like some of these off-price retailers that have just started to learn how to do omni-channel or have dipped their toe in online or learn how to be an online retailer, but used the pandemic to say massively cut costs, renegotiate rents, etc. So, I mean, I've talked about a couple of them on my blog, but you know, there's also a whole host of names like, okay, I haven't talked about this on the blog. I think it's interesting, so I'll bring it up just for fun. So there's a name in Japan called Koshidaka, which is a smallish cap company. They're a karaoke operator, right? So they basically just roll up some of the lower end karaoke operators in Japan. It's a very fragmented industry. It's a very stable business. Like the total revenue of karaoke over the last 5-6 years is basically flat. It doesn't go up, it doesn't go down, but it's kind of like a national pastime, right? So it's a pretty stable, dependable type business. Now the stock is essentially not just flat versus where it was pre-COVID, but like down significantly because they had two businesses. They had a gym business and they had the karaoke business.
Yeah.
A few other odds and ends, but essentially those were the two main businesses. And they spun off the gyms business to shareholders in the first kind of spin-off in Japan that's ever happened. And
really?
by the way,
first spin-off.
The first spin-off of, at least at a highish level, at like a Tokyo Stock Exchange main board listed company, right? So it was kind of a novel event, and the way they did it was almost all the tax basis in the stock stayed in Koshidaka, stayed in the parent company, which obviously did get hit pretty aggressively during COVID, right? So in absolute terms, the stock was way lower, and it also had all the cost base. So anyone that wanted to harvest the loss or is wanting to harvest the loss this year is selling Koshidaka, not the spin-off. So it was 90% in Koshidaka, 10% in the other. Even though the spin-offs were actually similar in size. So the market cap post-spin the gym business was a big part of the business. So if you strip it all out, it's still way down. If you have any kind of view that like behavior returns to normal post-vaccine, these guys are just going to go back to making what they were making. On that basis, it trades at like 5 times earning, right? So of course, there is a big question, how long does it take to go back to normal? And there is some, decremental economics from lower utilization, as you would expect, right? They don't own the real estate, they lease it, right? So there's some fixed costs there. There is some increased cleaning costs. So I'm not saying it's just linear ramp back up to what it was. Maybe it takes 18 months, okay? So maybe it's not next year, maybe it's 2022. Okay, so 5 times earnings, no debt or very little debt, great capital allocator. That's interesting to me, that kind of thing, right? And there are some other examples as well where, I guess you were asking about the stay from home, work from home winners, and I gave you like a recovery play. So I didn't really answer your question properly, but that's kind of what I'm looking at. So these kind of opportunities where they for whatever reason they haven't been noticed, they haven't been picked up yet. Maybe they're slightly smaller, maybe they're not listed in the US. Maybe for whatever reason, they haven't been picked up by Davey Trader. Actually, I'll give you a perfect example, right? So there's a company that's listed in the US. I actually think it could be a good short in the next 6 months. It's called Corsair Gaming, CRSR. So they just make gaming headsets and gaming computers and keyboards, right? Like, they have a good brand within the industry, but it's not that much different to like a Turtle Beach, which you've probably heard of here, HEAR, which is another headset maker. You
I
know
know,
the name.
I know Turtle Beach very well. Yeah.
You know Turtle Beach. So video game accessories or headset is a notoriously cyclical business, right? And if anyone sits down and seriously tells you that the last 12 months, or let's say the last 6 months plus the next 6 months aren't going to be the best 12-month period in the history of all video game accessories, they're completely lying.
I was about to say, you have Xbox cycle, PlayStation
Yeah.
cycle, and COVID cycle. Like this is the best it's ever going to get for these guys.
Yeah, exactly. This is like a once in a generation type bonanza. And of course, this was owned by private equity. It got sold a month ago or 2 months ago. They listed at $17. The stock's gone to 40. I think it went to 50. Now it's like high 30s, $40. Trades at a crazy multiple of peak earnings. I mean, this thing trades at 40 times EBIT, something like that. And yeah, they're printing 60, 70, 80% growth. They just pre-announced a great quarter, of course, right? But guess what? The lockup expires next March. Guess what? Then they have to anniversary the first post, COVID quarter. And, the private equity guys still own 75%. So if they were willing to sell at 17, what do you think they're doing at 40, right?
Yep.
And so on the one hand, you have those names, right? That for whatever reason, it's pretty obvious what's going on, and yet people believe the growth, right? And Wall Street enables that. And then you have the exact same kind of exposure elsewhere in the market. Like Turtle Beach is also listed in the US. So this is actually kind of an interesting example because it's also US listed. It has a pretty junky history, but it just wasn't an IPO. Like if Turtle Beach was an IPO today, I guarantee you it'd be the same kind of fervorous reaction.
Yep.
And it's not a large company. It's like 300 million or whatever, but it's high profile. It's got some analyst coverage, and that thing trades at like 10 times trailing earnings. Right. So it's like, on the one hand, the market is rational. Like, okay, we should put a low multiple on current earnings because we have no idea how sustainable it is. It's probably peak earnings margins, peak margins. And we've seen through the history of this company, they have channel stuffing issues every 3-4 years. They have massive inventory write-downs. Can they execute this time around? Is it different this time? All valid questions. On the other hand, you have a company that makes the exact same product, slightly different. They make computers as well, but the exact same end markets. It trades at 45 times EBIT. It's like insane.
Do you think part of that is because the private equity company has a much tighter float than Turtle Beach, so it's a little bit more prone to gets added to an index, and Wall Street Bets picks up, and they can just race that stock? Does that make sense?
Yes, exactly. I mean, a lot of it is technical, related to float dynamics, whatever. But then, even if you believe that, then you go to say Europe, and you look at some of these European names where they're similar tight float dynamics, but there's no Wall Street Bets. There's no guy bigging up the stock or looking at it. And those things trade even cheaper still. So you have this French company that, I did own early in the year. I don't currently own it, so no position. But, this thing trades at like half times sales, right? And Turtle Beach trades at 1 time sales.
Yep.
Because fair enough, who knows? And then Corsair trades at like 4 times sales. I mean, literally, they all make basically the same product. Okay, one is a joystick and one is a head, but it's the same underlying trend, right? And like, what is going on? Like, these are the kinds of things I look at. So if you do think that people spend more time in the home, and you do think that, gaming is a sustainable trend longer than just, okay, post-vaccine, people will still spend more time at home. That seems reasonable, right? There are still opportunities in some of these off-the-run situations. That's what I would say. These off-the-run situations, not in the high-flyer Wall Street Bets type names, but in these off-the-run situations listed maybe outside the US. So for a global investor, there's still plenty to do.
Wonderful. No, that was great. Let's just spend 2 or 3 minutes real quick. Last podcast, we talked about StoneX. The ticker there is SNEX. Shares there have done pretty nicely. It's up about 20% since the last time we talked, though, a little bit behind the market, which is up, Russell's up about 25%. It's only been 4 months, so you never want to base something on that short time. But any updates to the StoneX thesis since the last time we talked?
Well, Andrew, 20% in 4 months. By my math, that's 60% annualized. So good job. That's nice. I'm just kidding. No, so honestly, it's been a fairly quiet 4 months. Honestly, I was hoping for a little bit more action there. So I think last time we spoke about the reasons for the cheapness, right? And the main reason was this is completely undiscovered. No one's paying attention. That obviously hasn't changed a huge lot. So Jefferies did finally initiate coverage. I think they came out with a $70 price target when the stock was like $60. As you know, we both talked about some of the assumptions in that note. I don't think it was the greatest research note in the world. They missed a few simple things. Just to kind of highlight some of the basics, they basically assumed all the excess cash build in the business would sit on balance sheet and not repay debt. That was very high cost debt. right? So part of my thesis is they eventually repay and or refinance that 8.5% or whatever they priced bond deal that they didn't need to do at a much tighter level. But those bonds trade at like 4.5%, 5% yield, right? So there's a huge savings that drops to the net income line, which for a financial is the right way to look at it, that can come in the out years just from refinancing a lot of that unnecessary debt. That's point one. Point two is they assumed a huge normalization in GCAP earnings, in gain capital earnings, that is. And so, if you run through, they actually did break out their revenue assumptions. They basically went from assuming it does 100 million in revenues a quarter to somewhere between 50 and 70 million, maybe closer to even to 50 to 60 million. So 40% normalization, where if you look at the performance of similar businesses like Plus 500 or IG Group, CMC, some of these other FX trading shops, sure, the business is lower and volatility is not what it was in March, April, but versus say run rate 2018, 2019 numbers, it's still off the charts. So that's very penal. And then the third problem with the note was they didn't really make it clear where the synergies would hit. Like if you're looking at the pre-provision income, it wasn't clear they were seeing a margin boost from the synergies, which, as we discussed last time, should be very low hanging fruit, given it's basically all operational cost cuts like closing offices, closing duplicate functions, etc. So I think the real problem's not the right word. The real part that's still undiscovered with that story is simply the street getting the numbers right, which will happen. So, you have an initiation at 70, gives you room to be supposedly surprised, see the numbers come in, and hopefully they bump up that stock price. I still think it's more of an $80 to $90 stock out 18 months, with hopefully more of that return in the next, say, six months, let's say. The company hasn't done us any favors, to be honest. They haven't really marketed themselves. They're also a little bit slow on the current report because it's actually their fiscal year end. So so that's why they haven't reported yet for the current quarter, because there is typically for a normal company, there's a longer lead time for the annual report, and this happens to be their fiscal year end. So I think they're reporting in, they told me, the first 2 weeks of December, so it should be soon. Again, I don't think there's going to be any not rocket shoot, but there's not going to be any fireworks. The business is good. It's continuing to be good. It's more a question of what they do with the excess capital and what they guide to the synergy number for next year, I guess.
I do think, like you and I, our thesis was, hey, this is a business that's cheap standalone. They got a great deal buying GainCap, and that deal is also going to be very synergistic when they merge. And I do think part of it is like they closed the GainCap deal, and I think it was late June, early July. I can't remember exactly, but as you said, like this business, its fiscal year ends in September, so they closed the GainCap deal. They report Q3 earnings in August, right? They've got basically no benefit from GainCap. Yep. It's been 6 months. They haven't reported a clean quarter. Like they did this great deal that's going to have big synergies, but no one cares. No one cares. And it's going to take a while for it to flow into the numbers. But I think once it flows into the numbers, like as you said, every business similar to this, they're not reporting March type volatility record levels, but they're still reporting really good numbers. And I think maybe it's Q4 earnings, or maybe it's once they report, Q2 earnings next year or something. But I think once people get a clean look at this business and they see all this excess capital coming out of it, and they pay down some debt and probably start a share buyback, like I still think the thesis there is going to be really good.
Totally. I think, look, nothing has changed in either a good or a bad way, but the underlying thesis is still very much valid. And going back to your previous point about where the opportunity set is, that's another example of how this is kind of like a work from home beneficiary. Like the work from home part of it, no, but a post-COVID beneficiary is what? Higher equity vol, higher financial markets volatility. I think that's a reasonable assumption to make. And then we have the added kicker now of a democratic administration and potentially a slightly more inflationary environment, or a more fiscally irresponsible environment, which obviously should be hopefully good for interest rates, as in higher interest rates. And there's a huge added kicker we haven't even discussed, where if rates move 20, 25 basis points, they basically clear 15 million extra at the net income line, which is a decent amount of money for this business. So yeah, you're basically long that interest rate optionality, owning it, and you're paying a very low multiple of the, not even just the run rate earnings, but the kind of the normalized earnings are paying an extremely low multiple, even if you just believe their synergies at face value, which we both think are low. So the setup hasn't changed. It's great, but if I could sign up for 20% quiet returns every 3 months from every pick, guess what? We'd be printing 60% a year, and we'd both be sipping pina coladas in the Caribbean.
I like it. No, look, I agree with you. I think it's a free call option on interest rates. It's a free call option on if things got really volatile again for some reason. And even without those free call options, the business is really darn cheap. And if you look at their history, I think they've done a nice job. Anyway, anything else on StoneX, or I kind of want to turn to the newest
That's
pick?
it.
Okay,
Cool.
so let's turn to the newest pick. Jeremy posted an article on Seeking Alpha today. I'll be sure to include in the show notes. The company is Bragg. The ticker is Bragg, but it trades in Canada. So I just want to disclose both Jeremy and I are long the stock. This is a Canadian microcap, so nothing on here is an investing advice. Everyone should do their own diligence. Keep in mind, Canadian microcap, not for the faint of heart. So that disclosure out the way. Let me just turn it over to you. Who is Bragg? Why are we both so attracted to them?
Sure. Yeah. Let me just double up on your disclosure there. Just, I mean, look, everything, we're just explaining our views and our own opinions about securities and investments. But not only is it a microcap, it's a very small company. It's 100 million Canadian, under 100 million Canadian market cap. The enterprise value is even smaller, 60, 70 million, with a limited operating history. So again, this is kind of big boy pants rule. So for anyone who's just a casual listener, this is one of the high risk securities. So just please keep that in mind. With that out of the way, look, this is a very interesting situation, right? So at a very high level, Bragg is a provider of B2B software products for online casino operators. The easiest way to think about it is if you want to run an online casino, but you don't have the native software suite or the technical know-how, you will come to someone like Bragg and you'll say, okay, can you develop my backend systems? Can you build the player account management? Can you handle my risk management? Can you do the analytics on players? Can you provide me with content? Can you actually give me the casino games that I need? Can you integrate it all into a turnkey solution where I'm, abiding by all the regulatory regulatory rules that apply to my environment, right? So these guys have the relevant licenses mostly in Europe, let's be honest, right? So most of the licenses in Europe come out of Malta, actually. They're also licensed in Romania. They're also licensed in Germany under one of the states, Schleswig-Holstein, which is basically, we'll talk about Germany in a second, but that's where you get the licenses historically. And you'll go to an operator like Bragg and you'll say, okay, can you do this part of the business for me, that part of the business? And it really varies depending on the need and the want of the client, right? So it could be an all-encompassing casino in a box type offering where that you want the whole kit and caboodle done, outsourced to Bragg. Or it could be more, look, we just want your library of 4,000 games piped to us and we'll pay you a very small kind of, most all the revenues of that will go to actually the content creators, as it should. And Bragg will get kind of like a packaging pass-through fee, administrative fee kind of, or it could be something in between. So for, I guess, the vast majority of our listeners or your listeners are US based. So the best comp is GAN, G-A-N. This is the most similar business. Other than GAN, there are a number of other businesses where bits of Bragg or bits of these other listed businesses compete against Bragg. So for example, bits of what Scientific Games does would compete against Bragg. Bits of what IGT, International Game Technology, Playtech's not listed in the US, listed in the UK, but is also a pretty good comp. But the US listed comp that is, I think, a very similar business is GAN. And that's a business we've spoken about before and one I was quite familiar with from earlier in the year. I'm just
going to dump it. So longtime listeners will know once every third podcast or so, I'll say one of the business I missed was GAN this year. And GAN, Bragg competitor, they were London listed. They did exactly what you said, right? In London, they traded for 2 times revenue. They relist the US, and 3 days later, they trade for 8 times revenue, right? Same business, just switch their listing and they change for 8 times revenue. This is, I think it is the best Bragg comp, basically the same business, best Bragg comp. And I personally think Bragg is probably a little bit of a better business, but I'll leave that to the listener. Anyway, I was just jumping in with that background. I'll let you continue on Bragg.
Sure. So with that out of the way, there's kind of, I guess, 2 or 3 legs to the thesis. So the first point is this is a rapidly growing business, right? So, last quarter it grew 75%. The quarter before that it grew 100%. I mean, it's basically been growing, I don't even want to say high double digits because that probably undersells it. But the last 8 or 9 quarters, essentially, Bragg is the Canadian listed entity. It bought this business. It's called Oryx, O-R-Y-X. And almost all the operating business today is this Oryx business. Bragg is kind of the Canadian holdco that sits on top of the Oryx business, which is this is the software business that I was just referencing when I said Bragg. So to be completely clear, it operates as Oryx. And it's been growing rapidly for two reasons. One, it's been rapidly winning clients. So, this business was founded in the late 2000 or the early 2010s by a Slovenian entrepreneur whose name is Matej Majdi. I think I need to work on my Slovenian.
Brush up on your Slovenian, yeah.
Not my native tongue, let's put it that way. So anyway, it was founded in I think 2013 or something like 2000. I can look up the exact date. But it grew very rapidly from being a provider originally to just a couple of German-facing online casinos to, as of the last report, they have over 90 clients. And they've been adding, look, this year alone, they've added, I want to say 20 to 30 clients with another 10 to 15 in the pipeline for the fourth quarter. And yeah, it's been a highly successful growth operation, both organically, and then obviously you've had the tailwind from offline to online adoption, right? So basically the way these businesses operate is you develop the software suite, and maybe people who are familiar with GAN know this, but for anyone who's not, you get paid on the volume of business that's happening on your platform. So if you provide the platform to the casino and a ton of people come and bet on the casino, you get a piece of everything they gamble. And the percent you get depends on the extent of services you provide, right? So if you do one piece of the tech stack, you get a tiny percent. If you do the whole kit and caboodle, you get a much higher take rate, right? So you do get paid incrementally and or exponentially based on the activity on the platform. And the costs, obviously, of providing that platform are very similar, right? So obviously, server costs go up if there's a lot more activity. But other than that, you've already built the software. It's not as if there's a huge amount of cost. So these businesses are very much like SaaS kind of businesses, where as long as you're confident in the ongoing growth of the client and or industry, these things can start turning into very interesting cash businesses very quickly. So that's interesting, right? You have secular growth, you have organic growth, both in the industry, and they're winning a ton of business. Now, the second point is the one Andrew mentioned, and that is, that's all well and good, but this is still a Canadian microcap company listed on a crappy exchange. How am I actually getting paid, right? And that's really the key. So they articulated very recently the desire, not just the desire, but the game plan to relist the shares, not just to the TSX main board. So going from the TSX Venture Exchange, which is a very small exchange in Canada and hard to trade the shares, to the main board in Toronto. So essentially becoming a main listed Canadian company, which obviously opens up the share register to a huge number of larger institutional investors, professional investors who can't trade venture shares. That's step one. Step two, and obviously much more, from my perspective, much more important, is relisting on the NASDAQ. And so once they're on the TSX main board, which, look, I think happens quite soon, maybe very early next year, knock on wood, then hopefully thereafter and soon thereafter, they will look to relist on the NASDAQ, either via a dual listing, where it's not that hard for a Canadian company to actually dual list on the NASDAQ, or via a full formal listing, which might, look, again, in terms of timeline, there are some disclosures in the docs that suggest that has to happen in first quarter next year. I'm not sure, honestly, how binding that is. It might actually take a little bit longer than that. In any case, let's say a 2021 event, okay? So it's not too far away. That's the game plan. And so it's really twofold. It's one, you get access or exposure to an attractive end market growing at extremely high rates at a low valuation, in advance of, frankly, more eyeballs and more dollars being able to be deployed in it, either in Greater Canada and or Greater North America, which is basically the key, right? This thing is not going to trade at any kind of multiple listed on a backboard exchange, just like GAN. Once you put it on the same board next to GAN, I'm not saying it needs to trade at 10 times revenues, but it trades at 1.2, 1.3 times revenues today. So there's a lot of delta in between those two numbers. So that's kind of the story in the broad strokes, but you probably have some questions. Maybe you shoot the questions away, and then I'll discuss more some of the risks and opportunities that I see from here.
Yeah, so let's start with the question. I think the biggest question for any microcap, right, is going to be the management team. And I do think there is a worry with GAN. Correct me if I'm wrong, but they've had 2 CFOs turnover in the past 2 years. Their CEO just left over the summer. They've got an interim CEO out there. So I do think there is a question, like, when you first put the idea out there, I saw 2 CFOs turn over in a Canadian microcap, and I was like, oh my God, there's no chance I can give it part of this. There were some things I did that got me comfortable with it, but when I say 2 CFOs, CEO turnover, all that, how did you get comfortable with that? Why is that not it's a risk, but why is that not a huge concern to you?
Look at Andrew. I have a personal philosophy. I only buy companies that have at least 3 or 4 CFO turnovers in 12 months because I like fresh ideas. Okay. No. Look, in all seriousness, it's not never great to see. What I would say is, like, someone was saying the other day, you never have complete information, right? You never completely know what's going on. But it also makes sense why you would expect to see greater turnover at the very small end of the company's spectrum than the larger end, right? So obviously the risk degree is higher. The rewards of the current rewards are much less relative to the optionality if the company really hits it big, right? But you often see higher executive turnover at smaller companies. Like, so for example, at GAN went through 2 CFOs as well in the 18 months prior to listing. It was very similar. I don't have all the details for why they left, but they basically said personal reasons. There were a few other kind of yellowish flags there, and yet, as we discussed, the stock has gone up 6x, 7x, whatever it was. So
Look, I was emailing you. I was like, this red flag, this red flag, this red flag. And you were like, dude, you're looking at the trees and missing the forest. And I said, red flag, red flag, red flag. And I was very wrong.
Don't get me wrong. Sometimes it's important to look at the trees. We should try and look at the trees as well. So basically, both of the CFOs who left in the Bragg case, they both left for personal reasons. The very first one who left was more affiliated with the former entity. So as I mentioned at the beginning, the Bragg shell used to be a company called Breaking Data Corporation, which is doing something completely different. And they had an ancillary kind of media sports business that was kind of subscale, didn't really go anywhere. So the former management team, including the CFO, was more related to that Give Me Sports business. So that was CFO number one. Didn't really have a reason to be part of this new business because once it became Oryx, essentially it's Matev's baby, right? The only executives left now are the financial guys who put the deal together. And then people they've brought in subsequent to that who actually do have pedigree that we'll talk about. So that was the first CFO. Honestly, the second CFO, he wasn't there very long. I'm not entirely sure why he left. They mentioned only personal reasons. Having said that, they did replace him with a relatively pretty well-seasoned executive who I have spoken to, Ronen Kapoor, who actually is a bit of a deal maker, very experienced in the online gaming industry, who actually sold another company, Stride Gaming, to Rank, that company I mentioned earlier, who does have a good pedigree. So that was a step up. And then the real issue was, or I guess the real positive change, was the hiring of the former CEO of SB Tech, a guy called Richard Carter, who also has a pretty good pedigree. Now, look, SB Tech has a bit of a mixed reputation in the market, but they did sell themselves to DraftKings at a very high price. That was a great deal. This was the guy who put that deal together, and it hasn't been announced publicly because he's still in his non-compete, but I imagine he's the new chairman right now, but I imagine he's going to be the new CEO as soon as his non-compete expires, which is in a matter of months, right? So end of the first quarter next year, I believe, he's basically going to be tapped to be CEO. And look, the interesting thing here is this guy made a bunch of money selling SB Tech. He's not coming to this Canadian Microcap to make $5 million, okay, $10 million. Like, there's got to be more in it for him. So he either thinks he can really build this business into a very large business, another $1 billion business, which is what SB Tech became, or when he was hired, he specifically mentioned M&A. And frankly, there's no company doing aggressive M&A using one-time sales currencies. So, you can take of that what you will, in addition to knowing that the vast majority of Canada listing gaming software and or gaming companies end up getting acquired by larger players. You saw it with Stars Group, you saw it with NYX. I may even be missing one or two examples, but basically the two high profile ones, as soon as they get big enough in Canada, they tend to get acquired. And there are a lot of potential acquirers for this kind of business if the valuation doesn't improve. So look, I don't have all the answers with regard to the executive turnover, and it is one of the yellow flags. And again, I mentioned at the intro, small company, higher risks. This is part of the parcel. But I would say I do think it's going in a better direction from an executive standpoint. They still are a bit, not ready for game time, not ready for prime time. Let's be honest, they don't have a huge amount of public company experience. Some of the guys there, or at least that's my impression. But again, you're betting on the relisting catalyst. You're also betting on the secular tailwind, and then you're betting on the actual operating executive, which is the Slovenian guy. And we didn't discuss it yet, but one of the key things that gave me comfort with the thesis was when Matevs sold his business to this shell, he took a huge amount of the purchase price in deferred compensation. And that recently got renegotiated into an equity conversion. So it was previously a lot of cash plus a bit of equity, and it got renegotiated into, again, some cash, but 75, 85, 80% of it in equity. And the strike price of that deal actually got set at 73 cents a share, even though the stock at the time was in the 50s.
Yep.
And so he was willing to strike his equity exchange at a 40% premium to the then price to signal to the market, one, I'm not going anywhere. Two, I believe in the long-term prospects of the business. Three, I'm willing to take almost all my compensation for selling the business in stock, and I'm therefore going to become 35% owner of this business. Four, there's no way for me to exit without a sale, essentially, or some other kind of big liquidity event like going to the NASDAQ, right? So he was willing to signal all of that, and I tried to break that out in my note. And look, the stock's gone up a little bit since then, but maybe the stock's at 80 cents today. But essentially, you're paying 10% more than the guy who knows this business inside and out and built it, and that gives me a huge amount of confidence, even with the CFO turnover at the holdco level.
Let me just jump in there, because you hit the two things that ended up giving me the most confidence. A, the chairman is an industry, he is somebody, he sold SB Tech to DraftKings. He knows this industry cold, the online gaming industry. And maybe there's a lot of hair on Bragg, the holdco, but he knows Oryx Gaming, right? And he would not join, as you said, if he thought this thing was a strikeout or if he didn't see real opportunity. So him being there gave me huge comfort. And the second, Mike from NonGap, I said, you're one of the 2 or 3 subscription services that I recommend to everyone. The other one, I say, Mike from NonGap, you need to buy him. His stuff is incredible. And a big central thesis of his is, look, board of directors, when they've got a star, they often give them, options at advantageous times, or they roll their debt at advantageous times to give the inside management team a little bit of the pat on the back and to give them a lot of upside in the business. And when the founder of the company had stock struck at 73 cents, I said, oh my God, like the board and him negotiated, and the negotiation was, they set it 40% over the stock price. But I guarantee you, they set that thinking that the intrinsic value of the business was $1 or $1.25 with the potential to go to $3, right? Like they didn't set that 73 cents conversion price thinking that was the fair value. They were giving this guy a lot of value, and he had a lot of leverage on the company, and he chose that price. Exactly. So I just thought there was huge upside from that price.
Absolutely.
Those are the two things that kind of got me comfortable there.
Yeah, I mean, look, in full disclosure, I didn't even get involved in the company until I saw that renegotiated, right? Because it was a short-term liability and it was an overhang in the capital structure. It's a small company. This is like 30 million euro, a 30 million euro near-term liability that had to be crystallized one way or another. And, it's all over the disclosures of the company. This is a near-term liability. This causes significant doubt, going concern. So
the going concern,
Ronnie. It was a little bit additional hair too much, even for me. And looking at both of us, we're both pretty hairy guys, right? So
I'm a very hairy guy.
Just kidding. But yeah, so that was key. That was huge. I mean, look, he had them over a barrel, right? Like this earnout, the way it was negotiated, they had to pay basically in cash, 2-3 years into the future. And this was struck a couple of years ago. So he was coming up on his earnout. If they can't pay it, he could have taken the whole company. He could have said, I want my 30 million euro cash right now. In which case they wouldn't have been able to pay him. As a Canadian Microcap, the stock was 50 cents. They couldn't raise the equity. They would have had to file. And then Matevs could have taken the whole thing. Instead of being a 35% owner, he could have been 100% owner. But of course, you run the risk to the business in that situation. Of course, that would damage his customer relationships. That would not
lawsuits left and right. You've got to go to
play hardball. Exactly. But
you've got to go to your customers and say, hey, it's no big deal that we're in bankruptcy.
Exactly.
Trust all of your operations to my company. Like there are other things that.
That's true. That's true. Maybe I'm being a little bit facetious, but the upshot is the negotiated solution is actually a great one, both for existing and for new entrants such as ourselves, because look, we pay essentially the same price plus minus as the guy that knows the business inside out built it. And you're right, he's not taking stock at 73 cents if he thinks it's worth 80 cents, 85 cents, right? And similarly, SB Tech Carter is not coming on board when the stock's 75 cents if he thinks it's worth 80 cents, right? He's coming on because he sees an opportunity to compound for many years and a multi-bagger. So that's kind of the very broad strokes. I mean, let's talk a little bit about some of the risks, I guess, just because, normally you don't often see companies growing at, say, 70% and trading at 8 times EBITDA or whatever.
Yeah,
right?
please go
And
for
so,
it.
sorry. One thing before we talk about the risk, I should highlight that, I spoke a little bit about GAN and why I think this is a very good comp. We should probably talk a little bit about why I think this may, as you said, this may actually be a better business than GAN in reality, irrespective of a perception. So GAN's whole pitch is, I guess, two things. One, we're this great SaaS business. We plug us into casinos and online casinos and or sports betting, but mostly online gaming. As that goes through the roof, we have this take rate that all drops through the bottom line. We should be a 30% EBITDA margin business over time. Well, that's a great thesis. And then you actually look at the financials, and even on a very heavily adjusted basis for the first 9 months of this year, they're doing teens EBITDA margin, teens. And the last quarter, they did negative EBITDA margins. And the reason is not at the gross profit level. So they actually are seeing the gross profits come through in the 60-65% range. There's this massive expense load below the line. Well, not below the EBITDA line, below the gross line, right? So in administrative expenses, whatever. And they explain that as the cost of hiring new engineers, growing to a new level of scale. But conveniently, none of that was mentioned in the IPO roadshow, right? So what I'm really trying to say is they're growing revenues rapidly, but costs are also going up rapidly, which is not the hallmark of a SaaS business. What it suggests to me is there was a very large initial opportunity that they somewhat exploited in the growing US market. But as the business has become more competitive, and as a lot of that initial land grab has happened and or is happening, they're needing to invest a lot more to try and grow the business into different verticals.
Yep.
And that thesis is somewhat confirmed by their announcement that they recently bought a completely different business, a B2C operator, so a front-end customer-facing business, which is not even in the US at all. Whereas before they were 85% in the US and essentially a pure play US business. They bought this other business called Coolbet, which is essentially just a sports book and casino in Europe. And yeah, it's growing really rapidly, but we don't know where the revenue is coming from. And they're not making any money. So they could easily just be giving huge discounts, huge bonuses, a lot of advertising to win customers, get low calorie revenues in the door. And then they sold the business to GAN, who needs to keep growing revenues to prove out their valuation kind of thing.
I agree.
So that's kind of my now bearish take on GAN. Full disclosure, I do have a small short position in GAN, mostly as a hedge of my long position Bragg, right?
We talked about earlier, yeah.
But look, then I look at Bragg. Okay, Bragg is in nominal terms not that much smaller than GAN, right? It's a little bit smaller. Now, even if we strip out all the content revenues at Bragg, so I mentioned before they have this mixed model where a lot of the revenues is content pass through, and then some of the revenues are that much higher value piece, that recurring revenue platform business. Even if we just look at platform business versus platform business, GAN versus Bragg, Bragg is really not that much smaller. I mean, maybe it's like 25-30% smaller, but it's not that much smaller. It's growing basically the same speed, it was until very recently. And it's actually making money. Like, EBIT margins stripping out the content pass through are like 20%. Like at the company wide level, the EBIT margin is 15%.
Yep.
EBITDA margin, sorry, but it's not that differentiated. So the EBITDA margin is already mid-teens. Even if you look at their guidance for next year, which we can talk about that in a moment. Yeah, we'll talk about their guidance. It's still in the teens. I mean, yeah, there's some expense build. They've probably been running the business with a slightly oily rag the last year or two, given it's grown so fast. There needs to be a bit of investment, but it's definitely scaled much better. I mean, the numbers are actually there versus the GANs of the world is still a bit of a wing and a prayer. And so really the main difference between GAN and Bragg today is that GAN has a much slicker, better management team in terms of marketing the story. They were very sensible in coming to the US market and they're more US focused. But in terms of the actual earnings power of the business and business proposition moat, usability of the product and or diversity of the product, maybe they're similar, maybe they're not. But judging by clients, Bragg has 90 clients, GAN has, 20 to 30 clients. So yeah, just as a pure competitive product, it's not that easy to pick between them, that's for sure. And so, yeah, the valuation disparity on that basis is very hard to understand, absent the technical factors that we discuss.
And just one more thing on the clients, the reason I like Bragg a little bit more is they have 90 clients and a lot of them are smaller emerging market, or, they've got a lot of German, but they do have smaller, kind of Eastern European customers, a lot of those, versus GAN. They've got some pretty chunky US customers, right? And some people would say, oh, emerging market customers, that's a risk. And yes, there is some increased volatility, but to me, Bragg is a better business because they have less customer concentration. And the customers they do have, I think with GAN, you saw with FanDuel, hey, we want to bring this in-house at some point, right? Whereas if you're a smaller emerging market, you can't make that investment to bring it in-house. So to me, Bragg is a much stickier, and that diversity, yes, a little bit more volatility, but that diversity actually makes their business a lot stronger.
Absolutely. That's a key point, right? So if you can have a view one way or another about the whole casino in a box industry, but at some point your customers get big enough that they can afford to do it themselves. And, you know, if you're paying 5 to 10% take rate out of GGR or out of gross gaming revenue to your software provider, at some point the economics will make sense. You will try to develop or in-house that stack. And if it's cheap enough, like maybe you do buy a Bragg, which is essentially what DraftKings did with SB Tech, because they had cheap stock affected money, cheap SPAC stock-based coin to do that. That aside though, look, do you want to be in an industry where at some point you may or may not get in-house? Do you want 10 customers or do you want 90 customers? Your point is valid, right? Like the whole FanDuel aspect of the GAN story was great because, you know, whether or not they lucked into that relationship, it's clear at this point that FanDuel is in-housing on the sportsbook side. I mean, that's a done deal. They have a bit more of a runway with the casino side, just given the contracts they signed. But longer term, it's very difficult to see how that business doesn't get, you know, taken in-house or GAN gets disintermediated in some way. Whether it stays with them, that might actually happen too, but probably FanDuel will use their leverage to negotiate a much lower take rate or something like that. Whereas, as you said, with Bragg, if you have 90 customers today, and you have the top 20 customers are half the business. So, you know, it's concentrated, but still much, much, much less concentrated. You'd rather bet with the wider field. You'd rather bet the field than bet the one or two horses that you're forced to do with GAN.
Anything else you want to talk about here? Or I actually wanted to talk about the outlook real quick, because I think a lot of the pushback is consisting on the, so if you're good, we'll switch outlook or anything you want to touch on.
Outlook. Let's do outlook because it ties in with the main issue, which is Germany.
So, you know, I think a lot of people, let's just talk 2021. So with the Q3 earnings for Bragg, they came out and they put out 2021 earnings outlook. And, you know, look, it's not bad, right? They're saying, hey, revenue is going to grow at the midpoint. I think it's about 15%. EBITDA is going to grow, you know, midpoint, probably about 20% if I'm just kind of eyeballing these numbers. So a lot of businesses, they would love that, right? But for a business that's growing as quickly as Bragg has, and I'm just going to eyeball it again. I mean, you know, 2019 to 2020, it looks like they're growing over 50%, right? So for that, to go from 50 to kind of teens, that's pretty disappointing, especially with all the tailwinds and the new customers. So why don't we talk about a little bit about that?
Sure. Okay. So look, it's very important. It's probably the most important thing, other than the relisting and the technical elements of the thesis. This is the most important thing to understand. And honestly, this is where most of the risk lies. So if I was, you know, coming new to the story, this is the bit I would really try to diligence. So it's been growing very rapidly. Part of that is from new customer acquisition. Part of that is the tailwind from COVID, but honestly, it's much more from the new customer acquisition. Now, the key risk to the thesis is they have a very large German exposure. And as a function of the history of the company, a couple of their early clients who went with the full suite and then happened to grow very rapidly were German-facing businesses. Now, Germany is going through a regulatory change where before it was kind of like a gray zone where you couldn't. Online gambling is an interesting industry because, you know, a lot of these markets are either unregulated or in a kind of gray zone where you have gray market operators who have like a Malta license, right? Or an offshore license of, you know, Caribbean-ish, Aruba gaming license or whatever. And yet they'll then offer the games within country. And if there's no, Slovenia, I just pull it out of my hat, but if there's no Slovenian policy against online gaming, then theoretically those sites can offer it, right? So it's kind of unregulated. Yep. So in Japan, this is an example, for example, there's a company I'm invested in that has a very large Japanese business that's growing very rapidly. It's not that it's illegal in Japan. There's literally no rules governing the provision of online games in Japan. So it's just unregulated. And this continues for a number of years, and invariably these things grow because they're easy to access. People like to gamble. Then all of a sudden the government says, no, this is not good. You know, we need to regulate this industry.
A lot of my listeners are US. So just to put it in US terms, I mean, the way I've kind of thought about it is, hey, 5 years ago, daily fantasy sports, right?
Yeah.
It was unregulated because nobody knew if it was gambling or not. So they expanded a lot of places. And then eventually people decided that is gambling and laws were passed. They struck it down. But until then, it was a gray market, right? Nobody had said definitively yes or no. So you kind of operated that gray market until somebody says either definitively yes or no.
Exactly. It's a gray market. And so Germany operated in this region for most of the last 5 or 6 years, where you could get one license to operate from that one state I mentioned, Schleswig-Holstein, at the state level, but there was no regulation at the national level. That all changed very recently with the imposition of new rules. The new rules go into effect in stages. The first stage went in October, the next kicks in mid-December. And it's what's known as a transition period. They're still consulting on what the full rules will look like, and the new transition period, the transition period ends mid-year next year. So from July next year, you'll have the new regime. But chances are they're going to be relatively strict because the transition rules are quite strict. And so the transition rules basically they do things to try and protect and guide against problem gambling, which are obviously important, right? And so they've done things like institute deposit limits. So if you're doing sports betting, you can't deposit more than €1,000 a month per player, right? Which, given this is kind of like a VIP business, that's a huge imposition to sports betting. They've done other things where they've limited, I believe most table games are not allowed during the transition period until after the consultation. And then for slots, they've limited the amount you can wager on a slot spin to €1 per spin. And they've instituted, you have to have a cooling off period. So like a 5-second cooling off period between spins. So think about it this way. They want to basically reduce the velocity and speed of your gambling and the amount you're gambling, right? So there's various ways to interpret this. Most of them are bad, to be honest, for the overall market, at least temporarily. And so I guess this is kind of the background, the necessary background to inform this guidance, right? So let's go back to Bragg. So of this year's revenues, I think of their 40, they guided to €44 million in revenue this year, 43 million, 44 million. I think at least a third of that will be from Germany. At least a third, low 30s to mid 30s, maybe even slightly more, depending on how you categorize it. And so if you listen to the most recent conference call, they quantify that next year's numbers, as you said, they're still guiding to teens revenue growth, close to 20% EBITDA growth. They're embedding a €6 million hit from Germany year over year. So if they're doing 44 million of revenues this year, and at least a third of it is Germany, maybe more, what's that? Let's call it 15, 20, let's say 20 million. Let's say 20 million of Germany revenues. So they're saying the business is going to fall by 35%, Germany year over year. And because they get paid, they don't get paid out of earnings, right? They get paid out of revenues, gross gaming revenues. So they're basically saying the market's going to contract 35% next year. Which, look, it depends on who you ask. I mean, it's still a bit early to see what the true impact will be, but it's plausible, right? I mean, given the extent to which the new rules are being put in, definitely you'll see a contraction in the market next year. That's a given. Now, the interesting thing is if you look at some of the competing operators who also have German exposure, Bragg's clients tend to be more slots focused, right? They don't really have any sports betting in Germany. If they have it, it's extremely minor and not really a big part of the suite. It's much more slots, and there is some table game exposure, but my conversations with management, they said overwhelmingly slots exposure. So their average revenue per slot spin was already under €1 per spin. But again, that's an average number, right? So you don't know how the higher end player who's betting €2-3 per spin, are they going to double their number of spins at €1 per spin? We haven't seen that behavior evolve yet. So that is definitely a risk. And so this is all kind of baked into that guidance number. So what I would say about that guidance number is management was extremely conservative this year as well. They're going to beat that number by 20-25% from 2020 guidance. They had to give guidance they did a capital raising to pay part of the earnout. They were forced to give guidance as part of that capital raising process due to Canadian rules, which otherwise they probably would have said, we're not exactly sure how the business goes. And then the street would have been probably more aggressive than the company, to be honest. And so I think they're being overwhelmingly conservative in assuming kind of like a 35 to 40% decline in GGR for the whole market next year. Like if you think about Sweden, right? Sweden went through a similar process a few years ago. GGR contracted, but it was nowhere near those kind of numbers, right? It was kind of more like, from memory, it was a teens contraction, and the rules weren't as strict. To be fair, the rules weren't as strict, so it's not completely apples to apples, but it's Northern Europe, so I do think it's somewhat comparable as a situation. Go ahead.
Let me ask you a question on Sweden. So one thing I've been wondering with the rules, a lot of times you see something go from gray market to regulated, and yes, you do have that initial hit where nobody, you can't gamble €5 per slot or whatever. But a lot of times you also see eventually the market expands because, you know, if I'm MGM with a brand to protect and 20 land-based casinos to worry about, I can't go gamble and risk my license in a gray market. But once it's regulated, I can roll out the MGM branded thing and I can start grabbing people from physical casinos, right? And maybe, you know, my mom, she probably doesn't want to do something that's gray market regulated, but once it's regulated, she can go and do it. So is this a scenario where there's a short-term hit, but longer term that market can actually expand, or am I just kind of painting too rosy a picture there?
No, I think you're right. I mean, look, the tension here is not between good and bad. The tension is between near term and longer term. So you speak to the company or you do any kind of analysis, what you're saying makes exact sense and I think is right. And that is, in the medium term, this is a huge benefit to Bragg. I mean, to other operators as well, but Bragg, because they're dominant in the German market, you're going to have more entrants into the market. As a regulated space, you're just going to have more operators come in. Guess what? A lot of those guys are not going to be familiar with the market. They're going to rely on one of the larger B2B SaaS operators to help them get up to speed. They're going to outsource more work. And indeed, if you speak to the companies, they'll say that they're seeing many more inquiries, and all of those are some of the higher margin parts of their offering because people are preparing to enter the market. The only issue is you don't know when that's going to be, right? So you could have this reset period the first 6 months of next year, maybe even the first 9 months of next year, where you just have a speed bump. And so Germany grew very rapidly this year as well, more people at home, whatever, and the secular growth in online gaming versus offline. So Germany went from growing 30-40% this year, which has been disclosed by management, to next year it's going to contract 30-40% and essentially go back to what it was in 2019, I guess. And then it will rebase there. And then I imagine it will start to grow again and Bragg will still be a dominant operator and they will probably have even a more diversified business. But to your point, you'll have a lot more new operators come in. At this point, it's simply the lack of visibility that is causing the conservative guidance. So again, I don't want to get too Pollyanna-ish. It is a real risk. It is the main risk. We definitely need to see how it develops. But the point is, if you're paying 8 times EBITDA and a very low sales multiple of the already marked down numbers, which still imply 20% growth with these other catalysts to come. Yeah, I mean, you definitely have some risk if the German market just goes down 70% next year. I mean, that seems unlikely, but it's obviously possible, right? If they just decide to crush the market and all this gambling goes to illegal operators and, Bragg doesn't service illegal operators, right? So it's a possibility, but at the same time, then we'll set up, 6 to 9 months. We'll have another conversation like this in 6 to 9 months, and we'll be anniversarying 2020. We'll be looking to 2021 rather. We'll be looking to 2022, and the business will still be still be profitable, still be generating money, and we'll be looking to start regrowing again in Germany. And by that point, I imagine they will be listed in better jurisdictions. They will have an even more diversified business because they have started to win some US clients. Canada is actually going to start to open up from the sound of recent regulatory activity. We didn't even talk about that opportunity. And so it's more of a measuring the near-term pain for the long-term gain. And of course, if this stock was trading at 10 times revenues, I'd be extremely worried about this and we would not be having this discussion. But at a single-digit EBITDA multiple on already aggressively marked down assumptions, I think all they have to do is just hit those numbers and the stock can still easily re-rate a lot higher.
Let me put another twist on it. If I told you that I thought the management was just being overly or hyper conservative for a bunch of different reasons, they're going to get a new CEO at some point. They're looking to uplist. They just rolled their key employee just rolled into 35%. If I told you I thought they were being overly conservative because they do not want to miss 2021 numbers with all of that going on, do you think I'm being too Pollyannish, or do you think there's a chance they're just being way too conservative here?
No, I think you're right. I think the incentives for them the cost of them as a small cap Canadian company that just did an equity deal and will potentially want to do more equity deals or obviously insiders may or may not try to get out at some point in the future, right? Once it's a more liquid stock. The costs of them whiffing badly on guidance as their profile goes up is so much higher than the cost of setting the bar really, really low and worst case, just meeting that bar, right? So the way I think about it is exactly that way. Like they understand their position as a kind of high cost, let's call it a high cost of capital company right now, as a new entrant to the capital markets, as a new story to tell. and they really don't want to miss that guidance number. And yeah, if the cost of that is kind of this reset period where people kind of don't believe it for a while, or it's a bit of a show me story, and then as we go through 2021, they hit the number and or beat the number, which I think they can actually beat the number handily. Yeah, I mean, I think that would obviously, that's not going to hurt the medium term. That's the right way to play the game. So I think you're right there. Again, just I don't want to sound too cautious or too kind of wary. I just, there is still element of risk of how the German market develops. That's going to be key for the business, right? That's the key issue.
No, the real reason I think they're too conservative is, our listeners can go do the work here, but if you go look at their 2020 guidance and how it evolved from Q2 to Q3, I mean, the implied growth from it was insane. And they clearly knew they had the 2020 numbers in the bag, and they do not want to miss. So they guided way too conservative in Q2. And Q3, they upped the guidance a little bit. I still actually think it's a little too conservative, but I think these guys are just... I think they're just overly conservative guiders, and at some point maybe that changes, but it's not the worst thing in the world. And I think it's sorry. What else should we be talking about with Bragg?
I think that's about it. I mean, there's a few other. I mean, most of the stuff is covered in the note, and it's a bit in the weeds. So I don't want to go into too many details that aren't accessible in that note. So interested people can have a read. But yeah, I think we hit most of the key issues. I mean, I guess the one thing to focus on is the narrative around the relisting. So I mean, okay, yeah, this is actually a good thing to talk about very quickly. So you were mentioning before management quality and or my view there. So one thing that I didn't love about the most recent call is on the second quarter call, they mentioned specifically pursuing this relisting, right? Yep. And both the uplisting to the TSX, and then they had a throwaway comment about relisting in NASDAQ. And then that was outlined in the CDAR filings, right? So the regulatory filings, that was actually kind of outlined in black and white. So, those are legal documents, right? So I'm pretty confident that's still the plan. Then the third quarter rolled around. They basically had one question on the call from the one broker that covers them. They didn't even mention in the prepared remarks the plan. And I spoke to them afterwards, and I like them, but they said, we're still talking to the TSX. It's we're just figuring out what we need to do. I can't go on a call and say it's a done deal and it's not done. And I kind of impressed upon them, well, you don't have to say that. Just say it's still on track and you're still progressing towards the TSX main board listing, and thereafter dual listing or relisting on the NASDAQ when the time is right, as and when expediently as possible. Tons of companies say this kind of stuff all the time. So I do think there's a learning curve for management, as I kind of alluded to. But again, that's part of the opportunity, right? If management was bashing us over the head with all these catalysts or whatever, the stock wouldn't be at 80, right? It would be much more closer to what I consider fairish value, which is probably somewhere between $1.50 and $2. And so that's just one thing to kind of keep an eye on, make sure that process remains on track. Given some of the other, the risks related to the story as regards to a small Canadian cap, the way I think about it is this is a very attractive story in a very attractive niche, notwithstanding the fact that it's also a very small company with a few of the geographic issues that we mentioned. And therefore it's like, look, if we took GAN, right? If we took GAN, which in many ways is a similar story. If there was no prospect of it ever getting off the AIM exchange in London, do you really want to have your capital tied up in it, even as attractive as the story is? Okay, maybe it can re-rate from 2 to 3 times sales. Maybe it can grow. Maybe you still are involved. It's just the scale of the position and kind of the level of capital you throw at it is probably a lot less, right? So yeah, the catalyst is really important in these kind of situations. So if I was to counsel what the kind of thing that I'm focusing most on is deliverability on that. Because frankly, the business has performed great, right? Guidance aside, management kind of learning curve aside, it's hard to fault their execution. It's really about some of the softer deliverables that really make a difference to guys like you and I.
I 100% agree with everything you said. I would just, I do think I'm with you. Like if this never uplisted, I think it's a lot less interesting, though, it's cheap and it's growing quickly. But I do think like whether it's early 2021 or late 2021, like at some point, I think you and I both think this is a 20 to 30% top line grower that's going to be in a hot space that's run by the former CEO of SB Tech. Like at some point the TSX is going to be begging them to uplist to their exchange versus right now you and I are kind of like, we really want this to happen, but at some point every exchange is gonna be like, this is the type of company we want. You know, this is a sexy growth company run by a reputable team.
Exactly. A secular growth, 20 to 30% multi-year secular growth run by an owner operator, right? Essentially the guy is going to be, Mateus is this 35% owner run by a seasoned exec whose only mandate is really to maximize value, whichever way that comes. I mean, it's very rare to find those at all, let alone at this kind of valuation. So they should be begging them for it, and I just hope they get it done. Which I think
there aren't, there are 100 SPACs out there that would be willing to pay 10 times revenue for these guys.
Exactly.
Cool. Well, anything else you want to talk about here, or should we wrap it up here?
I think that's it for today. That's been a good dose of us.
Hey, well, look, love having you on again. Raver Capital. I don't say this lightly. I love the subscription. I'd encourage anyone to subscribe. I'll be sure to include the link to the Seeking Alpha Bragg article, which you know, obviously the subscribers had an early look at this, but and now it's public, so I think anyone can go check that out. And Jeremy Rickford, thanks so much for coming on. And hopefully next time we'll have some SNEX news. We'll have an uplisting for Bragg, and we'll just be talking about the next one.
Awesome. Thanks, Andrew. Always appreciate it. Great chatting, and speak to you soon.
Have a good one, man.
Cheers, man.